Alrighty then. Hello, everybody. It's me, Czarina. I'm hosting the Water Cooler Wednesday. Kevin is out. He's a little bit sick, so y'all stop coughing on him, and he'll be fine. I got with me, though, Mr. Speed. Say hi, Eddie.
How you doing?
And I got Buddy and Malin in the background. Say hi, Buddy.
Are you coming on with us?
Hello.
Marina,
Buddy.
are you coming on with us?
Oh, my bad.
Not me. You did your hair. Get on screen.
Hey, I didn't do it. I just last minute, just like that. See that? Anyway, this is how it's gonna look.
How you doing, Oprah?
I'm doing fine. Doing fine.
I like you when you do that Oprah hairdo, man.
I tried to, but it didn't look right. So I just right in the background. This is what we're gonna do today.
All right, cool.
So, you know, Eddie, that we like to bring a good topic to Water Cooler Wednesday. And some of the new students are not familiar with what we're about to do and what we're about to announce. But for those old timers, they know every few years and every once in a while, you've learned enough about the market and enough about where you think things are going that you actually make a shift in how we're going to be training students, what we're going to be focusing on and stuff like that. So that's what we're going to talk about today. It's kind of like, where's things going and where is Note School going to be as far as like getting ahead of it and making sure that our students are going to capitalize on it, right?
Yeah, and it's kind of funny. You and I were talking about it this morning, and you made an observation that usually I'm a year or two ahead of what people like are becoming like aware of the situation, right? Mm-hmm. And you're like, well, how do you figure out how to get a year or two ahead?
Right.
I don't know, Czarina.
You got that crystal ball. It's inside that deer head behind you. I know. He just goes over and rubs the deer.
I got the longhorn too. You see that?
I see that.
I bought it at the Child Welfare Board auction at Note Expo a couple years ago.
I remember that.
Yeah.
So we talked this morning, and originally what we normally do on water coolers, we have segments. So we talk about something for 15 minutes or 30 minutes and we break it up. But this topic is so big and we're going to dive pretty deep into it that we're going to take the whole session. And I think it's important. So what I titled this is how conventional voids and capital resources sort of tell us what we're doing. Because that's what I figured out after talking with Eddie for an hour. And then I had to write this stuff down. And as I'm writing it down, I'm like, oh, this is how he figures that out. And so I kind of reverse engineered Eddie's brain a little bit. And that's what I'm going to be presenting to you guys. He's going to help me going forward. You ready?
I'm ready.
All right. So what we're going to do, Eddie, is I want to take them through the cycles. I want to take them from 1980s all the way up until today. And the stuff that you've seen along the way that have changed. Okay, we're going to do the business like this now because of this. And we're going to change the business and do it like this so that they have an understanding of, okay, this shift that we're making in Note School is because all throughout these years, Eddie can predict, okay, this is what's going to happen. So tell us a little bit about the early 1980s, and then I'm going to flip it and it'll be the later 1980s.
So in the early 80s, what drove the inventory of seller financing, seller financing itself was high interest rates, right? Conventional mortgages were 18 or 20% interest, and people just couldn't afford to get a mortgage. So the only way you could do it is you assumed an existing mortgage, right? FHA, I don't even remember if they had Fannie or Freddie back then. I just don't remember. But, whatever conventional mortgages. And most of those mortgages back then, Czarina, were assumable.
Okay.
Assume the first mortgage. And if it was written at 8%, you could just continue right on paying at 8% interest. And then the seller would carry back an equity second. So if it sold for 100 grand, 60,000 assumption on the first, 20,000 or second, and 20,000 hours down, kind of thing, right?
Yeah.
And that was the original inventory that when I got involved in the business. And what tripped the other side of the business was that an institutional investor came to the market for the first time to buy seller financing. My father-in-law and his partner, Ed Langton, sold the first notes that Finance America ever bought. And so there was institutional money and there was all this product, and that was just a heyday in the market. I mean, it just boomed, and you know, the bad thing about it back then, quite honestly, it was just such an infancy business. We weren't efficient at things. We'd never really thought about it. We never really learned much about it. I worked for some smart guys, and they were smart at figuring out a lot of things, invented partials, really brought the first institutional money to the market. They did a lot of first time things. But I look back at some things I knew how to make it efficient. If I knew how to go do that today, we could have crushed it out. I mean, like insane.
Right.
You know, there's always a something, right?
Well, and it's hindsight, right? It's you being able to look back and say, oh man, if we knew what we had at that time, we would have done it differently.
Seller financing to the traditional realtor was probably the first time that ever even crossed their mind until 1980. So it introduced a whole world of seller financing that would have never considered it.
Exactly. So then we move on and we get into the late 1980s. And you said that sort of shifted because conventional financing came back down on their interest rate, and that sort of changed seller financing a little bit.
Czarina, I know this sounds funny, but I swear to you, I remember driving like 1985. I'm driving in the car with Martha, and I said, sweetie, if rates get to 10%, we're out of business.
Interesting.
And because I couldn't, nobody else would create seller financing. And what happened is people found a use for seller financing that never considered it before because they were introduced to it. Nobody selling a house is really excited about 90 days later hearing the slow no from the bank. We just need one more thing.
Right.
I'm just saying to you, everybody can act as tough as they want to, but that drives people nuts.
Big time.
Yeah.
And you also figured out, what you said to me was they were using seller financing in ways that they never had before. And it also had people who were in it, which was you at the time, thinking about how can I get more inventory? And that's when you figured out courthouse research.
Yeah, and I really did that in the early 80s. I actually did that. First time I ever did it was in 82, but it doesn't really matter. It's been eons ago. And I just, Czarina, I have never figured out anything in the first time I thought about it. Okay. And I've never resolved anything the first conversation I've had about it. And I think if you ask people that have been the most successful with us or people internally on our faculty, I mean, it's just the beating things up that make you figure it out. So I figured out that on a deed of trust that they put after recording return to, and it would have Czarina Harris, blah, 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 603 Jones Street, Little Town, USA kind of thing. And then I went down there and just figured out, okay, well, how do you go get a whole list of these and stuff? And that's kind of how it first started. Now that list, by the way, just pure courthouse research and not scrubbing that list, that was probably terrible delivery rate, right? Probably only delivered to 50 or 60% of the people I mailed to.
Oh, okay.
But
that's more than hindsight.
There was some big time inefficiencies in it, but even in spite of that changed our business.
Yeah,
and
for sure.
One time, Czarina, I'm going to fast forward a little bit. I know you're not asking about the 90s yet, but one time in probably 1995, before we buy a list from somebody like Scott Arpan, we had almost 100 people in the courthouses across the country.
Wow. Okay.
Seminary students and retirees.
All right. Use who you can. All right. So we're going to move forward a little bit since you're already there. Talk about the 1990s. And so this is where I really started to, when I was writing it down, I was like, all right, what is this man doing? And I kind of funneled it down into three things. So what Eddie does is he finds the conventional void. He finds out where the capital is, and then he pits those and says, okay, this is where seller financing should go, or this is where the industry should go. So talk a little bit about what was happening in the conventional void in the 90s, and then who was buying these notes.
Well, in the 90s, and I apologize, there was something big that happened in the 80s that's relevant, and that was the beginning of the RTC.
Okay.
Yeah. So that was a big relevant fact. And and that's where non-performing notes came into the marketplace. Up until then, nobody I knew in the whole note industry ever thought about going out and buying non-performing notes, particularly in packages. and they
Okay.
were selling these notes just like they do today. And that was the first time anybody had ever seen it. So we added that to business. And, you know, in the 1990s, the first thing that happened to me was HomeVestors. So
Okay.
Ken D'Angelo came along. I'd bought some notes from Ken back in the late 80s, and he was the guy that founded HomeVestors.
Mhm.
And he said, I'm going to have a franchise for people to be real estate investors, but they need to be able to create owner financing. But I don't need an inconsistent note buyer. And he originally approached me kind of frustrated with us.
Oh.
He thought I was a good guy, but
Mhm.
he said, you guys just are all over the board. He said, we just can't rely on what you're going to pay for a note. And I'm like, no, you guys are all over the board. We can't rely on what kind of note you're going to make.
Right.
One day you cook a pie and you put sugar in it. The next day you put salt in it.
Right.
And so we bantered. This was all good natured, by the way. And
Right.
we bantered back and forth. And you've heard me say a million times how much I love Ken,
Mm-hmm.
and how much the world lost the day he passed away. But Ken really pushed me into sitting down with him and coming up with essentially an instruction manual of how to make a seller finance note. And nobody had ever done it. And I know it sounds really simple today, but I'm telling you, when you're trying something nobody's ever done or nobody's ever even mentioned to you,
Right.
it's hard to wrap your mind around it. And so we went to Walmart or whatever it would have been at the time, and I guess it could have been Walmart. We went and bought 6 whiteboards and 6 easels, and every Sunday morning or every Saturday morning for probably more than 3 months, we wrote out on those 6 things essentially a flow chart and a minimum standard, credit, down payment, you know, things that would make them not qualify as far as what's on their credit report or other issues, child support, not paying child support, all these things, right? Just,
Right.
you know, we reverse engineered, and the only way I could do it was pull out old files. And I would sit there with a stack of old files that I'm talking about this high by my desk.
Mm-hmm.
And we pull out credit reports and whether it was approved or not approved and why they didn't do it. And we reverse engineered it just from looking at old transactions,
Mm-hmm.
things that would trade and wouldn't trade. One of the funny things that happened was the neighborhoods. And I said, you know, I never will forget one Saturday morning, I said, Ken, these note buyers aren't going to buy in the ghetto. I'm just telling you right now, they're not stupid. They're all consumer finance guys, and they're not going to go buy in some dangerous neighborhood because I said the collateral ain't safe, and the guy that lives in the collateral ain't safe.
Mm-hmm.
And I said that's the whole deal. You got an unstable deal. You can start out with people with the best intentions, but the day that their little girl gets accosted walking to school, the best payer in the world is going to default. He gonna move.
Yep.
And so then we're like, well, crap. How are we going to quantify a neighborhood? He said, I can't write it in my manual. Don't sell a house in the ghetto.
Mm-hmm.
And so we started out with this whole thing, and typically the old whiteboard thing. And we started out and just started drawing pictures, and we ended up with a 20 house model. So we'd have the subject house, 5 to the right, 5 to the left, 10 across the street. And then we did a rating of those houses, and that was called their number. That was the neighborhood rating system, and it was a 1 to a 4.
Okay.
1 was unacceptable. 2, 3, and 4 were. And you know, I got to tell you, for 2 guys sitting up there trying to figure it out, that worked pretty good. We tweaked it a little bit over the next months, but I'll tell you what, that changed the business. And they wouldn't make a private loan to a franchisee if it's in a 1 neighborhood, and we wouldn't buy a note.
Got it.
And so just so you know this,
Mm-hmm.
people say, well, how come you've never given us the neighborhood rating? Because it was HomeVestors' internal document. And I've always honored that deal. You know, I'm sure they don't use a neighborhood rating anymore, but
Yeah,
I've
we
never.
got more stuff for that now.
Anyway, so then when we, you know, to fast forward, now that's why you see us using something like RentFacts. So it
Exactly.
equates to the same thing. It's more scientific. It's fast. And but anyway, that was an interesting thing. So I built the HomeVestors note system, and that was the first time in the United States anybody had ever taken a swing at that. And quite honestly, prior to me doing that, no real estate investors really could sell loans to institutional investors because institutional investors were scared to death of them.
Yeah. Yeah. The underwriting was all over the place.
Well, they were scared of the investors tricking them, committing fraud.
Oh, gotcha.
And that's not fair because every real estate investor in that market was not dishonest, but there were some guys that would, as I call it, put the britches on you.
Okay.
They had already put the britches on some of these guys in the past.
Mm.
And they just generally just kind of, it's kind of like now they get the wide chalk out, right? Right over, they cross through everybody. And so I never will forget when I first started my guys at the associates who were executives that ran that division. I was really close to them. I mean, like I had lunch with them 2 or 3 days a week.
Okay.
And they're laughing at me like I didn't have any sense. But I really had a good feeling about Ken. I knew that Ken really cared. And so we changed the seller finance note buying business. And we did it kind of by accident or necessity. It's kind of like the Bible stories, Arena. When you read these Bible stories, those people that thought that their life was fixing to end, they didn't know they were going to be the Bible story.
Right.
They were just trying to survive.
Exactly.
And so that's what we did. And of course, once we did that, then associates became very comfortable with that customer and that product. And, that they went from buying 25 million a year to 250 million a year, probably in about 2 years.
Wow. Okay. So at this point in time in the 90s, you mentioned associates. Can you give us a little bit more on who that is?
So the original 900-pound gorilla, as the clock turned into 1990, the original 900-pound gorilla that was in the seller finance note buying business was a company based in Spokane, Washington. So if this sounds familiar to you with Tracy's background and, the ladies at Allied and all that stuff, yes, they all came from Metro. And Tracy was second in charge of production at Metro. So Tracy was a young lady with a high school degree that started out as an assistant and worked her way to an assistant processor and worked her way up to where she was second in charge of all the production of Metropolitan. And so, she was there and Sheila at Allied, if y'all know them, Sheila originally worked under Tracy because Tracy ran the closing department and Sheila ran the closing department and Melissa ran the servicing.
Mm-hmm.
So I've known all of them literally since prior to 1990 for that reason. And so then the Associates was the largest consumer finance company in the United States, and they bought a series of consumer finance branches in the Northeast called Signal Consumer Finance.
Okay.
And they bought 15 branches, and one of the branches was a branch that the guy had pioneered into buying seller finance notes. His name was John Zarilla. He's now at a company called Rock Top.
Got it.
So when we talk about all these people that we've known, it's pretty dang ironic that we all knew each other literally from back then. And so Associates was across the street from me. I officed on Los Colinas Boulevard in Irving, Texas, right up by the old Texas Stadium, the one that used to have the hole in the top of it. You see on TV. And so those guys that were execs over there, one of them knew me really well. His name was a guy named Gary Lee. So the first day they found out they bought that string of branches and they were going to buy seller finance notes, they called me up. Let's go have a beer after work.
Right.
And one thing led to another. And I sold the first portfolio that Associates ever bought.
How about that?
And so I sourced a portfolio, and they'd always bought one-off notes, but they'd never bought a portfolio. And so there was kind of a one thing after another. And it was a lot of it was I was with them every day. I had lunch with them. I was friendly with them. They felt like I really knew the business and I was credible. Mm-hmm. And the bad news is I set the stage for a lot of the business. A lot of people stole ideas from me that they went and implemented, and that's going to happen to you. And you got to get okay with that, right? Because I'm just saying, if I got my feelings hurt today, every time somebody had, run off with something that I kind of did, then I'd do it. And I'd get I wouldn't be able to function because my feelings would be too hurt. So in tandem of buying that product, I had developed by 1995 another funding source that liked to buy land paper and they were called Vanderbilt, and they were the finance division of Clayton Homes, which was a mobile home manufacturer in Knoxville, Tennessee. Okay. It's now owned by some cat up in Omaha, Nebraska named Warren Buffett.
Right.
So I got to know the Claytons, and the Claytons liked that product really well because there was a lot of mobile subdivisions. So mobile subdivisions that were zoned where you could move a mobile home or a manufactured home on it. And so they liked that because their goal is they were then going to collect these land notes and then ultimately marry these land notes into the mobile home loan. The mobile home was financed by a lender like Conseco, and the lot was financed by the guy that was the developer, right?
So let's pause for a second so that they understand. So back then, a lot of the seller financing that was going on was because financing could be found for the mobile home itself, but not the land that it was on.
Homeland financing was not a very efficient market.
Okay.
Now, it's been very inconsistent over the years. It gets good, then it gets bad, and it gets good. And but it was not very efficient. And the truth of the matter is, Conseco was trying to go buy their way in the market, financing anybody that could fog a mirror on a mobile home. And they didn't crap whether it was in a park or on a piece of land.
Okay.
Right. And so the land developers go, oh my God, this is crazy demand for people wanting to buy 1 and 2 acre tracts of land to go put their mobile home on.
Right.
So the mobile home industry was going crazy, predominantly driven by the availability of financing through Conseco.
Exactly.
Now Vanderbilt did their own financing, and so they wanted to buy this paper. And so they had a relationship. At that time, they called it an MBU, $1 million business unit. And they had to make $1 million in net income per year to go develop one of these units. And so I became a partner with them. Okay. And so we did an MBU for doing it. Back then, Kevin Clayton, who is now president of Clayton Homes, was running Vanderbilt. And their management was pretty thin. And I guarantee you, I probably had 2 hours worth of phone calls a week with Kevin Clayton himself.
How about that?
And so I got to know them really well. That's a really well-run business, and I really respect Kevin Clayton a lot. And like I said, he runs a business now that's owned by Warren Buffett. But that was the other side of the business. And I did that really strong for about 3 or 4 years. And once I started buying a lot of mobile home lot paper, mobile ready lots is how the industry referred to it.
Okay.
Once I started doing that, then it was a natural trend that I started going out and buying loans on mountain lots or lake lots, recreational land. People selling 20 acres of land, an hour and a half from Dallas-Fort Worth, so you could go shoot a beer can on it on the weekends. We're going to the farm.
Right.
So I started buying a lot of that paper as well. And so that became a piece of the business that was really something that we really pursued. So we were buying in that era, Czarina, we were buying maybe even more land notes than we were house notes, just because the land, there was so much of it and such an opportunity, but certainly 50-50 at best. And then I was actually buying those notes. And I would buy the land notes, and I'd buy the notes on houses, and I'd mix those loans together, and I'd sell them in a portfolio as a mixed collateral portfolio. Right. And the reason I could do that and it made sense is because the interest rates on the land were higher than on the houses. I could raise the rate in the portfolio and not have to discount the portfolio as much.
Exactly.
So I became a loan mixer, right? I mean, that's really what I would do. Before I could run Excel, this is probably 1998. So you guys can laugh. But I would sit in there with a laser pointer and put all those loans up on the screen and circle that loan right there. I said, take that loan out and put this loan in. And I was watching the average rate in the loan portfolio. And I was doing that because I could mix those loans. And so that really, that became a big part of the business. And we were buying home investor franchise loans and loans from other real estate investors, people that sold mobile home and land, people that sold land only with a mobile home on top, but not part of our collateral.
Right.
And that was, that was the business had never had that that thrust.
Right.
And
Well,
Vanderbilt had a glitch in how they were raising their money. And so late 1998, they called me and says, Eddie, we're not going to continue to fund this business. I will say one thing. I've always considered them the most credible people that as far as a company, not individuals, but as a company, they were the most credible company I've ever done business with, because they gave me 6 months to go replace the money I was funding the business with.
how
I
about
ain't heard of that. Usually they give you 6 minutes.
that? Right.
You know,
Wow.
but they did. And it didn't even take me 6 months, because I'd already had this model built and I was doing it with the associates. And so associates said yes. Now, by the way, most all these dirt notes, I'd say 90+% of all the dirt notes, I was buying a partial. And I was buying a partial to reduce the investment to value ratio.
Right. Well, in all of this too, you were probably the most prominent person doing seller financing and brokering and putting portfolios together. But there was a lot of competition at this time. There was a lot of people brokering notes and a lot of people doing this. Can you talk a little bit about that?
Yeah, so by the backside of the 2000s, you know, originally it was a company that was called American Cash Flow, and then later Fred Rui, who is Tracy's husband, was president of American Cash Flow. So he was the guy you saw in the infomercials. American Cash Flow was teaching people to do all kind of cash flow strategies, right? You could be a brokering factor, you could broker notes. You could do car leases, you could do equipment leasing, you could do this, you could do. So they were just teaching people how to go be fee income deal guys in the finance business, essentially what they did. But they fueled a lot of people that got into brokering notes. And by the late 1990s, it had gotten really competitive with note brokers. And then obviously, and that, so we stayed in that space, and we always stayed in that space of buying one-off seller finance notes. But our volume came from buying from professional sellers that created a lot of notes.
Right.
Yep.
And that's also too because you mentioned to me that if you were a note owner and you took back financing, within a few months, you might not get 1, 2, you might get a dozen, 2 dozen, 3 dozen solicitations. Hey, sell me your note, sell me your note. So there was a heavy amount of competition, and you figured out, I'm going to go develop these relationships with people who create a lot of financing. And that way I'm not only having less competition, but I have more inventory to broker and buy.
Well, that era was the beginning of the era that is very close to the era in real estate investing that we have right now. You know, any Dumbo could go buy houses in 2010. You didn't have to have a good personality. You didn't have to know anything about, sales or negotiating. You just made an offer to an REO agent. And if you could type on a computer, you could be a house buyer, right? Yeah. And I saw that era, and I said, this is short-lived. Mm-hmm. Today, you got so much fierce competition competing with you buying houses. You got to be a closer,
right?
You got to be smarter than your competition, work harder than your competition, and just be better than your competition. Market better, have a selling cycle, all that kind of stuff. So we didn't have a lot of pressure in learning how to buy one-off seller finance notes for many years. I think we got okay at it, but when we started, when all of a sudden we're bidding against a note and they've gotten a bid from 12 other people and they've gotten solicitation from 30 other people,
right?
Then all of a sudden we had to become a real note buyer, right? And that's a lot of where you see me play back to where I see the market of like where we are now. We've got such a terrific opportunity in people buying owner finance notes because there's not the zillions of note brokers there were. And we've got the expertise to show you how to close at an A level. And we didn't know how to close at an A level in 1988 because we weren't forced to go figure it out.
Exactly.
Partner, by 1998, if you weren't a closer, you were gone.
Right. So let's move on since we're up into 1998. Let's move on to talk about the early 2000s and Bayview's role as far as like how brokers made their commissions and things like that. And then also this conventional financing, what they're doing and what eventually we all know what happened. But how did that role play into one another?
So by the turn of kind of 2000, you would have generally said statistically seller financing was gone. Okay. And the reason you would have said that is because subprime lending just got more and more and more aggressive. And you'd think, well, nobody needs to seller finance a property. Okay.
Right.
Bayview came along with an audience that had been through the 90s, particularly the late 90s. And you know, Bob was at Associates. Bob had hired a lot of people from Associates or people who worked for me, because I shrunk by then, right? I didn't need the big staff because the market changed, and the best thing I could do was get skinny. Well, I had a great place for my employees to go to Bayview, so it was a friendly deal. And Scott went over there, you know. But I mean, I had a lot of high paid people, you know. I had a overhead of $5 million a year.
So Bayview kind of became the new Associates at that point. And if you were brokering, you knew Bayview.
Yeah, I mean, hell, 3/4 of their staff will work for me. That's how they learned how to do it. Right. In the College of Note Buyers.
Right. And so you talked about, you know, it started in the 90s where you see, you know, American Cash Flow, and then you see other TV infomercials. So what's happening is lots and lots and lots of people are learning about, oh, what's this note industry? And what, you know, that's how I learned about it, actually, was all the marketing that was going on. But the problem was the education. They didn't have a knowledge on how to do the business. They just knew it existed.
American Cash Flow, they said things correctly. They just didn't have a deep level of training. They didn't take somebody to the level we can. And so people left there confused because they just the story hadn't resonated with them enough times. They were certainly had a legitimate intent of teaching it correctly. Okay. Right. And I will tell you that Fred dang sure knew what he was talking about. But once again, he was working for a big company, and they had stock trading and this platform and that platform and stuff. And that he had to go operate within what essentially the people that ran the company wanted.
Right.
But then there was a cat that started in the 90s, and by 2000 he had really gotten it up, and he was doing a lot of infomercials, and it was called America's Note Network. A guy named Russ Dalby.
That's right. That's how I learned.
So Russ Dalby bought a newsletter from a guy that killed himself and his wife. He was a guy out in California. Okay. So Russ buys this newsletter. This guy can't spell note, but he's a marketeer.
Yep.
So he buys this newsletter from these people, and he calls Tracy's at Metropolitan. I'm kind of like the most well-known note guy in the country, right? Russ is trying to broker notes to me. Okay. And it ain't going very good. Let me just tell you that. Okay. Yeah. So he calls us and he says, I want to do this newsletter, and I'll be the work, and you guys like drive the market. And so we tried it. And so we initially owned a newsletter with him. We owned a business with him, but it didn't work. And we basically had Tracy and I just kind of took it away from him. And I wouldn't have bet 10 cents that this guy could ever go do something and be successful with it. And he went out and was earning $1 million a week. And that's how you got introduced into it.
Yep.
He got people every way, shape, and form you could think to essentially go broker notes.
Yep. That's exactly how.
By 2004, you would get, and I'm not exaggerating, you would get 40 letters in your mailbox a month.
Big time.
To sell your note.
And how I came into that era was my mom in 2002 had bought a house and took back financing on a second for her down payment. Yeah. And so she, as the borrower, was getting 6, 7, 8 solicitations. We'll buy your note. That speaks volumes to how much mail was going out, but it also speaks to the education level of these people, because you don't need to send the borrower, I'll buy your note. So that just goes to show how many people were doing it and how uneducated they were. But the thing was, there was a lot of people doing it.
Yeah, it was tremendous. In fact, in the early 2000s, most of the seller finance notes, a bigger percentage than anything else, were piggyback seconds.
Mm-hmm.
A piggyback second was created because people couldn't qualify for mortgage insurance. So they would do an 80% first, 10% second, 10% down, or an 80, 15, 5, or whatever it was. And so the bigger percentage of seller finance notes were just down payment assistance loans because people couldn't qualify credit wise or income wise for mortgage insurance.
There you go.
And it's funny because like that seminar company would go out there and tell people to run ads all over the place that will buy your seconds.
Mm-hmm.
If I had this conversation once with one of their brokers, I swear I had it at least 10,000 times. They would call me and say, I'm getting all these leads on seconds. Do you buy seconds? No. Well, who buys them? Nobody.
Right.
I mean, I know it sounds insane, okay, but I'm just saying it was one of those eras that, so that's how, to be honest with you, like if you're really old in the business, it's how note brokers in that era definitely got a bad reputation.
Oh, yeah, that's where the broker joker came from.
It was bad guidance and bad implementation, and it really didn't do our industry that well.
No.
But along the way, anytime you can run a lot of people at anything, Czarina, something every once in a while is going to happen good.
Okay. And I came out of it. Of course, something happened good.
That's exactly right. And I know some other people that I've met that have been note school rock stars that started in the same kind of thing. So it was a competitive market. Bayview was the 900-pound gorilla. Bayview really didn't buy a lot of dirt paper, and the reason they didn't was because they didn't buy partials. And the only way you could make a lot of land deals work with partial. I remember selling one note to Bayview, to Bob and Scott back then. Mm-hmm. I think this was $1.5 million land note on a $3 million piece of property, and Bayview bought it. And I made $150,000 commission on one deal.
Nice.
Banked it out, baby.
Look at you. All right. So now everybody knows what's coming, but they don't know. They know it from the conventional standpoint, what happened in 2008. But we're going to talk about it from the note industry side, what happened in that crash and what it did to the note industry. So let's talk about 2007.
Well, I was on vacation with my family in Orange Beach, Florida, down by Pensacola.
Oh.
Okay. And Scott Tyler, the same Scott Tyler that works for me now, Scott Tyler worked for Bayview, and he called me one morning, and he says, I could tell by the way he was calling me something was terribly wrong.
Oh. Okay.
I didn't know whether he had an issue with one of his family members. I didn't know. He wasn't crying, but he was not. It wasn't a normal, hey man, how you doing?
Right.
It wasn't that conversation. And he called me up and he said, Eddie, he said, Bayview discovered last week that they lost their ability to sell mortgage-backed securities. And so these seller finance notes that they're mixing with these other mortgage-backed security portfolios of, residential mortgages, he said, they're out.
Yeah.
And there's not any moment or any day or any situation in the note business I've ever seen that annihilated the business more than that. And they felt terrible. They totally knew us. They knew a lot of people. They knew it affected people's lives, but there was nothing they can do. They were funded essentially by Wall Street money, and Wall Street money was gone.
Right.
And
I put on here lots of brokers went out of business, but it was virtually almost everybody. Just about everybody.
I'd say less than 20 survivors.
Yeah. Out of thousands of brokers and broker jokers and everybody.
Yeah. And there was a reason for that. The reason for that is brokering to institutional investors was easy money.
Mm-hmm.
And I didn't want to go deal with some grandma, mom and pop, passive investor. I go take it to Bob, and he knew as much about the files as I did, if not more, and we could agree on what was a good deal or not. And you've heard us banter back and forth about that a lot. But I wasn't trying to trick a bunch of people. I was trying to buy paper that would pay, and they knew how to buy paper that'd pay. and I could go sell them 100 a month or 300 a month and go deal with a bunch of mom and pops, the individuals in one note. And oh my God, I don't know. What should I buy? Should I not buy? I mean, good God, that'd be brain damage, wouldn't it?
Absolutely.
So, nobody had a bunch of private money. And I had been buying dirt deals, not to the volume I had bought it anywhere in the past, but I bought a lot of that and I put it in my mother-in-law's business.
Mm-hmm.
And so we owned a pretty significant portfolio of notes in my mother-in-law's book of business, mainly partials. Sometimes we'd buy the whole note, but we'd do a holdback, right? We'd give them 60% of the money now and 40% of the money after it paid for 3 years or whatever, just stuff like that.
Yeah.
And anyway, so that business was okay. In the debacle, we had some slippage, but it wasn't as bad as you would think because we bought pretty decent paper.
Mm-hmm.
And but let me just tell you something. I mean, those were some dark days on me, Czarina. I mean, I had some days I looked in the office and say, how are you going to reinvent yourself? And I wasn't a big shop back then. And so I determined that if there was no conventional lending, then nobody knew how to seller finance. So I looked at it and said, here we got 1980 all over again.
Yep.
One of the first attempts I made was to go back and train realtors how to go do seller financing. That was a miserable failure.
I remember that. No pro training and all that stuff. They couldn't wrap their heads around seller financing.
Brain damage, baby.
Big time. Big time.
And so, I just was seasoned enough and resourceful enough that I kind of got back on my feet and started doing it. And then by 2009, these portfolios of non-performing notes started coming along.
Right.
And I played in that space real heavy in the late 80s and all through the 90s, buying defaulted loans from associates.
Mm-hmm.
So we had that division that bought non-performing notes, and I knew that space really well. So, that really, that just kept kind of changing the direction that I went in the business. But I will say one thing, and I know this is your last bullet that I see here on the slide, but I'm going to just tell you something. You remember the movie Gone with the Wind? Have you ever seen it?
Uh-huh. I have.
It lasts like 6 hours or something.
I know.
Right? Yeah. You remember when old Scarlett goes, when she swore, I'll never, I'll never do this again, or I'll never be hungry again, or whatever it was.
Right.
About 2008, I had that conversation with myself, and I said, I will never, ever, ever be reliant to run my entire business on institutional money.
Mm-hmm.
And I had the vision of Notes Direct back then. Now, it took me a lot longer to put this together and a lot more things. Now, we had a trade desk and stuff like that, and you've run that. David Phelps ran that. Ralph ran that. We've had something like that for a long time, but not the efficiency that we have today or the volume that we have today. But
right.
I swore off back then that I was never going to be relying on that one 900-pound gorilla investor, because no matter how good they are, the employees, when they're out, you're out of business.
Exactly. So now we're going to move on to 2014 to today. So we've kind of gone through the 80s. We've seen the cycle.
2007 to 2014, the dark years, won't we, Czarina?
Yeah, we're going to call that the dark ages. Well, it wasn't. You know what? We can't, because, non-performing notes came back.
They did.
In those days. And that brought a lot of people. A lot of our students came in at that time because they couldn't find inventory. And they're like, oh my God, where's all the inventory going? And it's non-performing notes. So we can't really call that too dark, but.
We had some students in 2010, 11, and 12 that crushed it out of the park.
Big time.
I mean, crushed it out of the park by non-performing notes. And so I don't want to sound like it was, but it was not, it was more of a horse trading era, right? Mm-hmm. And that was definitely the case. And so, and I don't know, I don't remember exactly when you came along. Was it 2010? Is that about right?
Yeah, end of 10.
Yeah. And And I'm going to tell y'all a funny story. Czarina didn't like me. I found Czarina because she wrote something bad about me on one of these chat rooms.
I did not write something bad about you. Here's what I did, so I can clear my name here. Eddie did an interview. It was a phone interview, and he was talking about Note School, and I was trying to find out better training because, again, I came through that whole Russ Dalby thing, right? And I was young. I was like 20-something, 22, 21, something like that. And I didn't have the $25,000 to pay Russ to teach me some business. I was like, I don't have that kind of money.
Well, he had gone to the penitentiary by then.
Oh, yeah. But he was still trying to squeeze out money out of people. So I said, man, I need to find somebody who's doing it. Well, they have this thing called the Paper Source, and they have all these people. And Eddie's name is always somewhere. And I was like, I know this guy's name. So I listened to the interview, and he's talking about Note School. And he says something funny. He was like, you know, when we're talking to these note sellers, they might get $1,000 a month, but 18 months later, they don't have $18,000. They ain't got a dime. And I just thought it was hilarious. I'd never heard him talk before. So I took the clip where he said they ain't got a dime, and I put it on my blog that I was like chronicling my journey trying to be a note investor. And I said, well, maybe I shouldn't put it up there. Maybe I should tell him that I clipped him and put it up there. And I was like, maybe he'll think it's funny. He didn't think it was funny. And that's how we met. That's how I met Eddie.
I don't exactly remember what happened. I remember it was something that she did. She didn't think I was very legitimate. I'm just going to tell you that. And so anyway, that's how we started, and it was kind of funny at that in that era. I was always trying to reinvent Note School, and so I used Czarina. Had a lot of skills. And in fact, to tell you that in the early days, how Czarina and I got started was it was really a trade out. You know, she did a lot of development for me, and that let her pay for essentially what became a titanium.
Right.
With us, and that was the case. But in that process, Czarina ran these calls. They used to be phone calls. They weren't webinars, but Czarina did this for me for years. We've had crazy amount of fun together. We've seen all kind of funny stuff happen. And but we became buddies, and she really got to know me, and you know, she developed this sense about the business because she heard me respond to people over and over. Well, I'd do this, or I wouldn't do this, or whatever. And there's no doubt that, you know, she has still to this day monitored or ran the boards for more calls from me than anybody probably ever will at Note School again. I mean, we're talking about years, and she did every call.
Yeah.
And but it's been a good endeavor, and it's enabled you to go develop this stuff for us, Czarina, because you have such a background of seeing these different things and hearing me respond to things. So okay, so 2014 comes along, the market comes back. A lot of owner financing is created from 2010 to 2015 because 50% of the people don't get a mortgage.
Right. Credit crunch.
Yep. And so there's seller finance notes. And if you see the notes that Scott Tyler prices from this broker network, half of them are pretty dang seasoned notes. I mean, you're talking about 3 or 4 years plus season. Right. So there's an inventory out there of these kind of notes, the most underserved market of people chasing those notes. So that's why we keep referring to the opportunity in brokering notes.
That's right.
I mean, you have to broker every deal. You can buy and hold and broker some and do whatever, which is what I think you ought to do. It just depends on, you know, where you're at in the business. First 2 weeks, first 2 months, first 2 years, first 5 years, right? That's all going to be a different answer, right? And but what became obvious is even though the credit came back and you could get a conventional mortgage, there wasn't conventional mortgages for low price band real estate. And I kept looking at all these BPOs, right? Yep. I'd look at thousands of BPOs, and I'd look at the comps knowing that if a house rents for $800 a month or $700 a month, there's no way it could only be worth 30 grand. Except there wasn't conventional financing, and it was a cash market, and most real estate was a terms market, right? Because they go get third-party loan. It'd be like looking at the boat business or the car business, and there's no financing for cars or boats. I promise you the price of those products would go down.
Exactly.
Right? Same thing, because people are buying payments. So I saw that, and and for all the reasons you've got listed there, it's it was CFPB and Dodd-Frank and SAFE Act and and stuff, and the lenders just basically said, look, we ain't making no money doing a low price band loan anyway, and that's the one we get our brains whipped in on, and we end up being stars on TV, so we don't want it. We just out. And we really that's why the market in about 20 states never really recovered. You saw Denver and Detroit, not Detroit, Denver and Portland and Seattle and the Bay Area. I mean, their market's just rocketing by 2000, even in 14 or 15.
Mm-hmm.
And then you look at where you live, you look at Cincinnati, or you look at Detroit, or you look at, and they're like, they weren't even close to recovered. And it was just because of a lack of conventional financing. And so it became evident to me that we needed to reintroduce seller financing as an exit tool to go do that. And, that's not even creative. That's not even creative, Czarina. It's just, I just seen it so much. I just knew that was a natural impulse,
Right. Well, and what's also different now is we don't have those. Not a lot. We don't have that big gorilla, that one person who's going to be buying seller financing. It's a lot of these private guys like Martha selling a crap ton of partials to just private people who from the crash said they had their own never again. Right. And they said, we're not going to be in a market where it's going to be have my life savings crashed in a market like this. So they decided we need something else.
Well, so by the beginning of Note School, I had an affiliation with one or several of the IRA administration companies. By 2012, I'd done training for at least 6 or 8 of them pretty extensively, right? Mm-hmm. And in 2010 to 2012 or 13, people that had money in a self-directed retirement account, and those self-directed retirement accounts grew like crazy because people left corporate America and took their 401k money with them. Yep. IRA companies call it rollover money, right? It went from a 401k to an IRA, right? And so those companies, like the money they had under administration was just like, it was going like this, right? Because people were leaving corporate America, early retirement because of recession. And then everybody could buy a property at an insane price. So they could do a private loan to use Czarina, and you're buying a house in Houston or Dallas that was way too cheap. And so it was just a really efficient market for real estate investors to buy properties and people to make private loans against them. And that's really what the self-directed retirement account space employed more of their money at than anything else, way more than anything else. Okay. Mm-hmm. So literally like half or more than half of Quest IRA's business was deployed in private loans.
Yep.
And that was pretty normal. Probably true with equity trust, probably true with IRA services. So then all of a sudden I'd really built a relationship and done a lot with these guys. And by 2004, in a lot of markets, the price was becoming a different issue. And so these investors that were sitting on self-directed retirement accounts couldn't get their money put out for the next deal. Right? It was such a no-brainer in 2012. Anybody could have figured out this is a safe loan. But by 2014, that wasn't the case. And there became something that really, really, really changed. And that was the dry cash factor.
Exactly.
And this corporate executive, that had been at an oil company or been, wherever, right? Left, and the private loan paid off. A successful private loan pays off in 5 months. An unsuccessful private loan pays off. Well, you figure it out a year later, they're not going to pay. That's what you do.
Exactly. You figure it out too late.
So that's a business, and it's not a portfolio, right? And so you had all these people that really thought they owned a portfolio of notes, and they owned a business because if they did it all right, they got paid off in 5 months, and they had to go do it all over again.
Mm-hmm.
And the problem is they didn't have deal flow. They don't do what we do every day. They don't want to do what we do every day. And they don't have deal flow. And so I saw that. And so when Bob Repass had come along, and that's been 5 years ago, more than 5 years ago, close to 6, then, he and I had a long history, and I just, you know, I just said, listen, guys, I mean, we need to, we got to have a capital fund, and we got to go raise our own money. For one thing, the other people that we've done business with don't always, they provide inventory to students, and they're not always careful as we would be. And secondly, I've made them rich. And I'm not being greedy. I'm just saying I made them guys rich because I built the student network that went and bought all these assets.
Loans.
Yeah.
Yep.
And so, but I knew, I understood the operational side and the executive team and what all that meant. So I fully understood it was a trade-off. When I did it, it was not an inexpensive proposition. So I saw the market was at that point the most robust in growth of people that had dry cash and needed a deal. And then I started trying to match the inventory to people, the inventory that was out there to the inventory that people had with dry retirement account cash. And that's why literally from the history of us selling the first loan, over 40% of it's been funded with self-directed retirement account money.
Yeah.
And so we totally saw that and understood it. And we built Notes Direct with the thought in mind of kind of having scales of notes. Okay. So think in terms of there's a passive investor that really the type of asset he's buying is probably at an 8 yield. I know they all want 14%. I got that.
Right.
But it's really an 8 yield deal. And I know that's not going to fit a lot of our mentor students, but they'll buy it at 8 yield. And I needed that A product that was like super clean, brainless investment, and it's going to fit that A yield. Okay. A pricing, A quality. Okay. Then that's really where the note school people plugged in, right? Then you're looking at a deal that's more like 9 to 11. And it's probably a good quality deal, but it's, you know, it's a land contractor. It's this or it's that. It's just not that. It's got a little more brain damage with it.
Yep.
And Bob and I saw that we could buy these things too cheap.
Right.
And because they were land contracts and the guys on Wall Street didn't have a tolerance for it and so forth and so on. And then we bought about 2,000 of those assets. We've sold
a lot.
1,200.
Yeah.
We probably sold 1,200 of them.
So Eddie, that's going to bring us into, well, that kind of goes into what I call you being, instead of reactive, you got proactive. You built the trade platform. You started saying, okay, we're going to start driving this. Instead of the market happening to me, I'm going to go out. I'm going to start this fund. I'm going to do all this other stuff. So that now brings us to our last slide, which is what seller financing is doing, why we even did this whole story on all these cycles and looking at the market and looking at what conventional lending is doing. And now it's kind of brought us into what we're talking about today, this shift that we're going to now be doing with Note School and making our students look at seller financing in different ways. And so I've listed out 6 things. There's probably more, but I've just listed out 6 things. If you want to get a high level, we're not going to go deep dive because we're almost out of time. High level, what are these things that we're not seeing that now we're going to be making students focus on? And you want to talk about some of this stuff.
Well, I hope we've hit most of these. So I tried to tie it in with the story at the moment of it. Lack of brokering is that there's not big seminar companies driving brokers. That's why there's a lack of brokers.
Right.
Okay. And then we ran out of institutional money and they ran out of the business. Now we brought money back to the business, and Note School is a force in the seller finance space, but we're not spending $1 million a week on TV. So we're never going to have the body that some of those big seminar companies had, right?
Right.
That's why there's a market void of people that are out there buying these notes. And every time there's a void, I see an opportunity. Okay?
Exactly.
So number 2 is a huge amount of seller financing occurring at better quality assets. And that is because people have woke up and realized if they create a seller finance note and they do it right, there is a secondary market. And we have built this whole matrix and, hey, we can do this and owner finance and that kind of thing. But it's totally, absolutely a result of us trying to go rebuild what we knew to be a very efficient market for
And
seller
not just that, but all those houses that you talked about that are just not being financed, period, because the bank's not touching them.
Huge market. Listen, let's talk about the top three. Okay. You got low price band. Anything under 80 grand is probably not gonna get a loan at the bank. You got Fannie Mae and Freddie Mac that are very difficult, where people that are self-employed. Hell, Fannie Mae and Freddie Mac, there was a report that went out like a week ago that 90% of the loans they make are 700 credit and above.
Wow.
Okay, so and they're not solving the needs of people that are self-employed. Okay, now I'm not saying any of these things are all perfect. The other thing is ITIN buyers. There's more foreign nationals living here than ever. And now they want to live here and stay, and they're legal, but you know, they most loan programs are going to wall them out. I say most, I'm being clear about that. So all of those are market voids. All those combined is a gigantic number.
Exactly. Number 3, this high demand for specialized knowledge and financing. You talked about that a little bit earlier. Talk very briefly about the problems that's facing these real estate investors.
They don't know what they're doing. They're not trained. It would be like you're sending a grade school kid in to go look at a distressed house and figure out if it's got foundation problems. Okay, they're not trained, and there is a huge opportunity for you to go out in the marketplace and develop these folks for this very reason. And it's a gigantic opportunity, and it's, you know, even in the era I developed a lot of things, you know, through investors and what I associates and later Bayview. But let me just tell you something. I was far from Eddie Speed being the only guy in the business.
Right.
You know, now were we big operators? Yes, but I still couldn't say that I represented half of all of their business. That's not true.
Oh yeah. Number 4, we talked about, you know, private capital. They want alternative investments. They just do.
And the stock market's better than it is. You know, the people that I think know the most about stocks say that it's going to be a roller coaster in the next year. I mean, it's going to be really good and record and everything's good. And then all of a sudden it's going to be like it was, you know, a little bit back where, what's going to happen and whatever. It's going to be that. So, you know, listen, if somebody says that I want to go take all my money and throw it back in the stock market, I'm going, why did you tell me in 2010 that when the market was $10,000 you want to do that, and now it's 25,000 you're comfortable with it? That's kind of like, that doesn't make any sense.
Right.
Yeah.
More demand on note investors to know underwriting. Talk about that for a couple seconds.
Well, if you're going to buy seller finance notes that has limited seasoning, the average seasoning of a performing note we've bought in the last 3 years is probably, you know, 3 or 4 years seasoned. Okay. It doesn't take, you're just buying a pay history. People ask about the credit report on a loan that's got a 4-year pay history. And I say, for what?
Yeah, exactly.
But as you're buying fresh notes, then you have to know more about the characteristics that are likely to happen in the future of that customer and whether that loan will pay as agreed. Exactly. So yeah, there's going to be a need to learn more, an opportunity when you know more to go do things that is really going to expand how you can go do the business.
And not just that, but you're going to use the underwriting not just in acquiring, but also using seller financing as an exit strategy if you're doing non-performing. So you need to know how to create those terms if that's what you're going to do.
Yeah, one of the things that you've heard me mention is a big opportunity is, you know, buying property with seller financing. And I've been on a big campaign to go reverse engineer and develop a lot of, you know, examples of what has happened, because I think people are just completely unaware. We find that about 20% of all seller financing written in the last few years is written at 0% interest.
Right.
That means the buyer is smarter than the seller.
That's exactly what that means.
Yeah.
Yeah. Half the time they're doing it on accident too. They don't know what the hell they're doing.
Yeah.
So
All right. So the last thing is the NPL strategy. And let me just tell you something, the NPL inventory is not getting cheaper.
No.
So if you don't have a smarter strategy than buying it and then calling a realtor to go sell it for you, then your margins are going to shrink to an unacceptable number. Okay?
Exactly.
And so you're going to have to utilize seller finance strategies to get the gross up and how you sell that house. Because once again, you're selling it for cash. It's a wholesale market, so forth and so on. So they all, now you can see they're all really kind of tie back in together. This is why we talk about this underserved market. But the whole conversation started with me going into me and you talk, and you're saying, Eddie, I've seen you make these forecasts over all these years. And it was really like, I think you made a very good analogy of, okay, how could I've done a pretty dang good job of predicting what was going to happen in this business about 2 years before anybody else was calling it.
Yeah.
So how did I figure that out?
Well,
smart, because you know me too well.
This is what I say is that you figured it out because you look at conventional lending. What's conventional lending do? Because they're on one side or the other, conventional and seller financing, and then you figure out where's the capital, where's the money. And when we had easy conventional financing, there had no seller financing. And then when we had no capital, in the case of like Bayview going out, well, then seller financing was done. And so I was like, okay, this is how, and I went back to all these stories that you told me, Eddie, and I was like, damn, that's what he's been doing this whole time. It's he looks at conventional financing, he looks at capital, and then he predicts this is what seller financing is not only going to do, but what it needs to do. And so we've done that now. And so people think, oh, Eddie's just talking again because he wants people to do brokering. That's not the case at all. It's because look at all these things. I mean, we've only listed 6 here, but look at all these things where seller financing, it either is going to be creating fee income for you, or it's going to be an exit strategy for you, or it's going to be, building wealth for you, all these different things. And we're not utilizing it. And people really don't have to worry about, oh, is some infomercial going to come out and tell people all this stuff and I'm going to have all this brokering competition? That's not the case. But now you literally have people who own seller financing and never get a letter saying, hey, sell your note to me. I mean, that's unheard of from the times that you were in the business. And so when you have virtually no competition and you're just sitting there like, oh, I really need to make money, it doesn't make any sense.
Well, the thing is this, we become accustomed to the environment that we're given. Mm-hmm. Okay. And so what's happened with us, Czarina, is, by the 1990s, it became a competitive market and we had to become a lot better closer or we wasn't going to get our share of the business. Right. By the 80s, it was such an infancy business. If you were just kind of a good old boy and like to hear old women talk about their poodle dogs, you could buy notes. Yeah. Okay. I'm serious. I mean, you just didn't have to be that talented. You just had to be a listener. Right. Mm-hmm. But then all of a sudden you started getting some people on the phone that could close and that understood a selling cycle and that kind of thing. And really to be honest with you, my mission for these guys is to raise their bar way up, because I'll be honest with you, we're satisfied with being less than really A players doing this now because we don't have to be. We can have some success and be less than an A player. And I got no interest in being, I want to be the bobsled champion from Phoenix.
Right.
You got what I'm saying?
Yep.
I don't care if I'm the only guy in town that does it. I want to be the best as the people of Norway that do it. And there's other people in other related aspects of real estate that are closing machines right now because they have to be. Competition says if you can't be better than your competition, you're going to get squeezed out. And I see that as being an opportunity to really up our bar. And we can get there because I think we know how to do this. I mean, I'm confident we know how to do it.
For sure.
Real estate investors creating seller financing, using seller financing to buy properties. I'm just going to say that these are all things that are the market is doing, but the market potential and growth in it is literally seriously Czarina, we're talking about in 2 years, it could change 10 times very easily.
Mm-hmm. Big time. And it's just getting that knowledge to these people. They don't know what they don't know. And a lot of our students have all these skills and they're not using them. They're not utilizing it because it's kind of, like you said, it's easy just to play a B level. You don't have to be an A level because you're doing well at a B level. But we're really trying to shift. And this is, again, going back to why we started this water cooler, is we're really going to start shifting and pushing you guys to start doing this, start looking, start implementing it, and start using it because it's there.
Right. And one of the things, like I see, some of these guys that are putting comments up there and stuff, like somebody just asked, how do I get a list of seller finance note holders? And the answer is Note School has built a very elaborate system for dropping mail, from a list vendor to sample pieces you can use to a selling cycle process. So that's already done. You can be satisfied. That's done. And I appreciate your question, because if you don't know the answer, you don't know the answer. But believe me, I can say comfortably, Czarina and I have spent thousands and thousands of hours addressing this subject. Mm-hmm. So that's really done. And I like the fact that, if the one fun thing, Czarina, I get to do in the business, kind of including my part, mm-hmm. One fun thing I get to do is I get to go take 37 years experience, some of which has had a lot of heartache in it. Mm-hmm. And I get to go then fast forward you guys into something that it may have taken me 10 years to figure out. Right. I can, what I gave you is a summary today of crazy time and energy and stuff to go figure out. And yes, I pay a lot of attention to the elements in the business and what the business is telling me. I observe this a lot. I spend a lot. It's not easy for me because I spend a lot of time studying it, right? I think about this a lot. I ask lots of questions to lots of people in the market that give me a sense of where the market's at. And once I think I have kind of an inventory or where the why the market is what it is, then I think I'm pretty decent at rearranging how we go about it to go say that's a market void, and we make money when there's a void in the market or there's an inefficiency.
Yeah. And it's not just even that there's a market void. I mean, there's voids, plural, all over the place. There's with brokering, with financing, with exit strategy. I mean, it's all over the place. And seller financing, that's what it does. It fixes these voids.
I had a guy in my office last week that owns a company that bought 1,800 flip houses last year. Mm-hmm. I mean, if there's anybody bigger, I don't know who they are.
Okay.
And he lives in Dallas, but I know him from the past, and he came to see me, and we talked about this very strategy of buying property with seller financing and selling property with seller financing. And he sent me an email a day or two later and says, look, I've really resonated on what you said, and I think you're totally correct. This can change my position in the market when my cash just doesn't get it done.
Exactly.
Right? My buyer doesn't get it done. And I see that you're opening up something that can drastically change my direction that I take my business. That's a guy that bought 1,800 flip houses last year. If he sees it, then, I'm just telling you, he knows what the market is.
Uh-huh. All right, Eddie, we're over time. You got last second things? I'm going to let these people go.
I guess the only thing I'd say is, Czarina, you and I have had a fun time figuring some of this out.
Oh yeah,
and sure. You came along, and you were very much as green as they were, the people that started with us.
Greener.
And I think you just would look back to say it's a story, and the more you hear it, the more you're going to piece it together. And there's a point of it's always honestly kind of confusing, and then all of a sudden it kind of snaps into place.
Yep.
If we're pressing ourselves to be A players, we're always pushing tighter, harder, faster, smarter, all that stuff. And so, I'm never satisfied with just sitting back and saying we got this figured out. I'm never going to be satisfied with that. Right. But you have not been either, and you've helped us a lot, and I appreciate it. And by the way, there's probably no person. I've been on like hundreds of podcasts, and I've never had anybody interview me that's more comfortable than what we did today.
Hey, I'm just gonna leave it right there.
Barbara Walters, baby, Barbara Walters.
I'm telling you, my head's getting bigger. It's already big. You know what I mean? All right, everybody. From now on, when Eddie says, "Hey, we're gonna start going in this direction," for those of you guys who are new and have never really experienced when Note School says, "Hey, we're gonna go after this and we're making a change," you're in for a ride. So thank you for coming. I'm gonna put this up, buddy. I'm gonna send this to you so everybody can get a copy of this PowerPoint. It won't be as fancy, but you'll get a copy of it and just kind of be on the lookout. We're making a shift, baby.
All right.
All
See
right.
you guys. Thank you.
All right, good night.
Thanks, guys.